Before we dive into yield and yield to maturity, let's have a quick revision on bonds. So what are bonds? Well, these are IOUs or similar to loans taken by the government or companies from investors, and how they work. Well, let's take a look at some bond basics by looking at a particular bond. If you were to look up government bonds in the exchange, you would find something like this. So, first of all, you'd have a word like treasury. That's name of issuer. Then you'd have a percentage, so it might say 8%, and you'll find a date, 2029. Doesn't have to be 2029, doesn't have to be 8%, but let's take those as examples. And then, up price, $113, let's say, normally just 113. So, here's a government IOU issued by the USA government. Why? It needs to borrow. Just like you and I, the government gets income, tax for example, and it spends it on defense, schools, health services, all those kinds of good things. And if it spends more than it earns in income, it has to borrow the difference. So, the government issues these bonds, commonly known in the UK as gilts, in USA as treasuries, and in India as GSEC. This is the coupon. It's fixed. Now, not all bonds carry a fixed coupon. You can get things called floating rate bonds, but we'll leave those to one side for this video. So, fixed means what? It means you know that this bond pays exactly $8 as what's called a coupon, and it does so every year. So, the government or part of the government called the Debt Management Office, which is mostly the central bank of country like US Fed in USA, will make sure that the holder of this bond receives a coupon of $8. Why $8 and not $80? That's because of something called as nominal value, and usually that's $100. And the nominal value is not the market price. That's over here, but the nominal value tells you what you can expect to receive in coupon terms. And it also tells you how much the bond will be worth when the government buys it back from whoever's got it. In other words, pays off its loan in 2029. And people worry about the nominal value of a bond. They think, well, if the price is 113, what is the nominal value? Think of it like buying vegetables. If I go into a grocer and say, what a kilogram of carrots? It's a kilogram of carrots irrespective of who buys it or when they buy it. Whether it's you, me, the grocer, or my next door neighbor, it's non-negotiable. Whether I buy today, tomorrow, or after 1 year, it will still be 1 kilogram of carrots. So think of nominal value as similar to 1 kilogram of carrot. The price, however, is negotiable. Today, you might be able to purchase 1 kilo of carrot for $1. After 1 month, you may buy it for $2, or maybe after months, you could buy for half a dollar. So think of market price of bond as price of carrot. So the nominal value is £100 to everybody all the time. But the market price is whatever the market buyers and sellers say it's going to be. And it changes. So if a bond has a nominal value, you can say the coupon is $8 fixed. And in 2029, I can expect $100 back from the government. This is the redemption for maturity date. Okay, so there's a basic bond. And the nice thing is that these are features of both corporate bonds and government bonds. A coupon usually fixed, a maturity date also usually fixed, and a price that's definitely not fixed. I've just checked 113 in for my example. Now back to yield and yield to maturity. Bond investor, like any other investor, has two main questions. First, why would you buy one? Reason number one, it's backed by a government with a high credit rating. So one reason to buy is you're probably not going to have to worry about bankruptcy or default. But that's not enough, is it? Second question that investors have is, even if I want to buy, is it worth buying? That is, what about the return? As an investor, I'm thinking, well, I don't need to buy one of these for 113. I can be buying shares, or I could be putting my money into a bank account. So how do I know? And the answer for an investor is yield return. I want to know what return this thing offers so that I can go out and have a look and compare it to something like a share, or perhaps a bank account, or perhaps indeed another one of these. So let's take a look at two return calculations useful to investors. Okay, number one is what's known as a flat or income yield. Very simple calculation. Some investors buy for income. They just want to know what a $8 coupon means as a percentage of the current price today in return terms. Flat yield is often quoted as FYKIN in exchanges. In our example, if I take a $8 fixed coupon and divide by the current market price as a percentage, I know roughly what my annual income return's going to be. And here, that's about 7.1%. So if you're purely buying for income between now and 2029, you can expect a yield based on what you paid of around 7.1%. That sounds pretty good for something backed by the government. And it's almost too good because I've forgotten something. The problem with flat yield calculations is that they ignore the fact that if I purchased for $113 today and only get $100 back in 2029, I've lost $13. A second calculation builds that in. Let's build in an adjustment for the difference between what I paid today and what I get back in up in 2029. Okay, the name of that calculation is the yield to maturity. If you look at up in newspaper or something, you might see a column headed up YTM. The second calculation, and in practice, it's a bit of approximation as I have to get into the time value of money, recognizing that dollar today is worth more than a dollar next year. But I promise this approximation will help you understand YTM concept better than any formula. And you will never forget the logic also. Basically, YTM says is what you need to do is recognize you're going to lose $13 over roughly 4 years. That is when government plan to buy this thing back. So a bit rough and ready, if I were to take the $13 and divide it into 4 chunks, that's for the 4 years, I reckon I'm looking at basically a $3.25 lost every year. And to turn that into a yield to maturity, all I need to do is the following. What I could do is say, right, roughly speaking, I get a $8 coupon, I lose $3.25 as a sort of capital loss every year, and I want it as a yield, as a return on my original investment. So I could say the true yield to maturity, that's this thing, the YTM, is more like 4.2%, which is much lower than 7.1% yield. Hope now you will never get confused with what yield is and what yield to maturity is. Alright everyone, that's all for this session. If you liked this video, then please like, share, and comment on this video. And also subscribe our channel for more such videos.